Welcome to the debate from MacroSpire.com. Before we begin, this content is for informational and educational purposes only. It is not financial advice and should not be relied upon for investment decisions. Past performance does not guarantee future results. Always consult a qualified financial advisor. Today, the hawk and the contrarian go head-to-head on. Gold at $4,500 is still overpriced after the dip. Let's get into it.
Gold rallied 3.4% today to $4,553 and everyone's calling it a buying opportunity. It's not. This metal is still overpriced with real yields at 1.6% and a correction that's barely halfway done.
Overpriced? It's down 19% from $5,595 in January. This is the biggest pullback in gold in years, and you're telling me to sell into it when central banks are still loading up?
Central bank buying is actually slowing. The pace has decelerated meaningfully, and the market is still pricing in peak accumulation that isn't happening anymore.
Slowing from record levels is still buying. These aren't speculative hedge funds, these are sovereign nations making a structural decision to diversify away from dollar reserves. That doesn't reverse on a dime.
But the dollar isn't collapsing, which is the whole premise of the gold bull case. The DXY is holding up fine, and the Fed funds rate is still at 3.64%. That's not exactly crisis mode monetary policy.
The Fed cut from 4.22% to 3.64% in 5 months. That's nearly 60 basis points, and the cutting cycle isn't over. Gold doesn't wait for the last cut, it prices in the direction of travel.
Sure, but the 10-year is at 4.34%. You're earning real money in treasuries right now. Why would anyone hold a zero-yield asset when you can clip a 1.6% real return risk-free?
Risk-free? With $36 trillion in federal debt and deficits running over 6% of GDP? Treasuries are only risk-free if you trust the government to never inflate its way out. Gold doesn't have a counterparty.
That's a philosophical argument, not a market argument. Right now, today, positive real yields are a headwind for gold. That's just math.
It is math, and the math says those real yields are shrinking as the Fed keeps cutting. Gold ran from $1,800 to $5,595 while real yields were positive for most of that move. The old playbook is broken.
Or the old playbook is reasserting itself, which is exactly what the 19% decline is telling you. The speculative froth is coming out.
Froth comes out at the top. This is a pullback to the 200-day moving average after a multi-year bull run. Technically, this is where you buy, not where you sell.
Technical analysis on gold is hand-waving. Let's talk fundamentals. The Iran premium is already baked in. Every geopolitical risk you can name is already in the price.
Already priced in? We've got active conflict in the Middle East, tariff escalation reshaping global trade, and sanctions fracturing the dollar payment system. Which of those is getting resolved next quarter?
None of them need to be resolved. They just need to stop escalating, and the risk premium deflates. That's the asymmetry bears see geopolitical premia fade, they don't compound.
Except they are compounding. The tariff situation is getting worse, not better. And every new round of sanctions pushes another central bank toward gold reserves. This is structural, not cyclical.
I'll grant you the central bank bid is real. But it's not unlimited, and it doesn't justify $4,500 gold when the macro backdrop is a growing economy with positive real rates.
A growing economy that requires 6% fiscal deficits to sustain itself. Strip out the government spending and tell me how healthy it looks. Gold is pricing in the endgame of that fiscal trajectory.
Gold has been pricing in fiscal doom for 50 years. Meanwhile, treasuries have paid you to wait. At 4.34% on the 10-year, the opportunity cost of holding gold is enormous.
And gold is up what, 400% in the last decade? The opportunity cost argument only works if you assume gold goes sideways. It hasn't. It won't.
It's down 19% in 2 months. That's not sideways, that's a trend change. The question is whether you're catching a falling knife or buying the dip, and CPI at 2.7% with a hawkish Fed tells me it's the knife.
A Fed that's cutting rates is not hawkish by any definition. And 2.7% CPI with rates heading lower means real yields are compressing. That's the tailwind gold bulls are buying.
We'll see. But right now, at $4,553, you're paying a massive premium for a hedge against a crisis that hasn't materialized.
By the time the crisis materializes, gold will be at $6,000 and you'll be explaining why you didn't buy the pullback. That's how every gold bull market works, it climbs a wall of skepticism.
Bottom line, positive real yields, a stable dollar, slowing central bank buying, and a geopolitical premium that's already in the price. Gold at $4,500 is still a sell.
Bottom line, a Fed cutting cycle, sovereign diversification out of dollars, unresolved geopolitical risk, and a 19% discount from the highs. This pullback is the gift of the decade. The hawk, the contrarian, thank you both. What do you think? Let us know in the comments. Read both articles in full at MacroSpire.com. Thanks for listening to the debate.